Let's be clear, Bitcoin is an international asset.
We are spending like drunken sailors.
Bitcoin is the only economic entity where the supply is unaffected by the demand.
If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable.
Thank you for joining us for this week's episode of Scarce Assets, a podcast from Onramp Media. On today's show, Bitcoiner and longtime hedge fund manager James Lavish joins Andy Edstrom and Jesse Myers to discuss the current state of the Bitcoin market and the impact of inflation on the global economy. They explore the role of Bitcoin in fixing the broken monetary system and the need for financial education. They also delve into the expansion of the money supply, the ongoing debt spiral, and the challenges of addressing a growing national debt. James also explores Bitcoin's path of monetization, the importance of institutional capital flows, and the potential for Bitcoin's volatility to dampen as it matures. And now, time for the show.
Hello, I'm Andy Edstrom, and I'm happy to welcome you to the 11th episode of Scarce Assets, a show that examines scarcity, the most fundamental driver of economics and markets, and the scarcest asset of all, which is Bitcoin. It's great to be here with my friend and co-host Jesse Myers and our guest James Lavish. Now, James is one of my favorite Bitcoin educators because he has the knowledge of Bitcoin and because his background is in traditional finance. He's a partner in the Bitcoin Opportunity Fund, so he's investing in Bitcoin companies and opportunities, which is something we'll talk about. And he writes the Informationist newsletter, which is a great resource that I enjoy reading and that I recommend, especially for its clear explanations of how things work in bond markets and in money markets. So I'm happy to welcome James to the show. James, how are you?
It's awesome to be here, Andy. Thank you for having me, and it's good to see you and Jesse.
Excellent. Well, James, let's wind back the clock a little bit to November of 2022. I moderated a panel with you and David Thayer and Morgan Richard at Pacific Bitcoin, and that panel occurred as FTX was melting down. Bitcoin had dropped below 16K, having fallen from a peak of about 69K a year prior. And we talked about whether the institutional narrative for Bitcoin was dead. Now, since then, the ETFs got approved. Is that the only difference between 16K Bitcoin and 64K Bitcoin today?
No, I think it was, that time was when we decided to launch our hedge fund. We decided to go ahead and establish it because we saw so many opportunities out there. Bitcoin is just super volatile. It always has been. And it doesn't surprise me at all that when we had the FTX and Celsius meltdowns, that all of the fraud that we had in the space, that Bitcoin took not the brunt of it, but took quite a bit of the pain and followed the market down, or led the market down as it would be, because it's the most liquid asset in the space. And so not surprising at all. And as far as, is it the only difference? No, I mean, it is a big difference that the ETFs have come in, and we can talk about that. And they've been helpful. They've been a very positive, development in the Bitcoin space. But in reality, I think that quite a bit of that washout occurred. It went a little bit lower than we would have expected in the cycle. It probably clipped the top of that cycle, but here we are in the next cycle. And a lot of it has to do with just the halving, the 4-year cycles, and where we are in that.
At Onramp, we believe that Bitcoin will be the most important asset to own in the 21st century. Our multi-institution custody solution is the safest and most secure way to ensure that your Bitcoin remains in your and your family's possession for decades to come. Multi-institution custody maximizes security and minimizes counterparty risk, leveraging Bitcoin's native properties to eliminate single points of failure that have historically complicated Bitcoin ownership. Onramp provides peace of mind for your Bitcoin journey. For more information, check us out at onrampbitcoin.com.
Yep, that sounds about right to me. I wonder, with respect to your newsletter, The Informationist, has your focus changed over time in that intervening period? I mean, you do a great job of talking about the big picture credit markets, the nuts and bolts and the mechanics in plain English so people can understand, and then weaving that, Bitcoin's role into that. Do you feel like that has evolved in that intervening time, or was it kind of always the same thrust and the same idea?
It's hugely evolved, but I wouldn't say it's because of Bitcoin dropping. It's because I started the newsletter realizing that I had this knowledge and information experience that most people just don't have, being in institutional investing and being in that world for so long. It's pretty opaque. These people are paid to keep you in the dark, and there's no real incentive to educate people on that. Knowledge is power, and wealth really in that world. So I wanted to bring some of that to people, but in kind of conjunction with Bitcoin knowledge. Now, when I started doing it, Andy, I realized pretty quickly that people really they want to understand the nuts and bolts of finance. And at the same time, I realized, look, as if I try to convince somebody that Bitcoin is the answer right out of the gates, that doesn't really work. What is become extremely obvious, apparent and blatantly obvious, is that people need to understand that the money's broken. And if we start there, then we can lead you to the path where you make your own determination that, yeah, Bitcoin is a no-brainer. So, that's kind of how it all came about. And I've found that more and more that I talk about traditional finance subjects, like bonds, the bond market, the treasury market, the reverse repo market, the repo market, how the Fed works, how the Fed makes their decisions, their meetings, how that all comes about. People are fascinated by that because it gives you that grounding, that base of knowledge that you can then extrapolate to apply to your own investments, and then to why Bitcoin really does matter, why it makes sense. So that's kind of how it evolved. But then, it's been fun. I enjoy it. Yeah.
Yeah, I love it.
Yeah, it's interesting to me that you are able to pull back the curtain, and that's the best form of education. It's just showing like, well, here's the man pulling the lever, or the rudimentary mechanics that are very human and imperfect behind the curtain, and that's really kind of the first step, or it was for me, in coming to Bitcoin and coming out of the sort of general worldview and mindset of everything is run by professionals who know what they're doing. That's kind of what you're steeped in when you're coming up in school and then early in your career. And that's the assumption that most people have. When in reality, you look behind the curtain and you see that they maybe don't understand the second and third order effects of policy decisions that are being implemented today.
Exactly. And, when you try to bring somebody into the space and understand what's going on and why Bitcoin is so important, like we saw yesterday, we saw that Chris Pan was, he tried to, he gave a speech at Ohio State, right?
Yep.
And he came out, and I don't know how long into this, I heard the clip. I don't know how long into the speech it was, but he started talking about Bitcoin and they immediately booed him.
Yep.
And part of that is just ignorance. Part of that is because, we've lost the ability to teach these kids how to critically think in college, which is just a shame. Some colleges still do it, but by and far, you can see that that's a big problem. A lot of groupthink. And so, but reality is, if Chris had more time and if he had structured his speech differently, I think coming at it about, from the angle of, hey, look, the money's broken. Here's how it's broken. Oh, and by the way, Bitcoin does fix this.
Right.
That might have been received better. But I know that because when I first learned about Bitcoin, I would do the same thing. I would walk into, I would have a dinner party with my wife's friends, these poor people, and I'd just start talking about Bitcoin, and they were like, "What? No, that's a scam. It's for drug dealers. It's for sex traffickers. It's for shady individuals. It's not real. It doesn't have any airline." And so it took me a little while to learn that, I just have to educate people and remind them how manipulated our system is and how it's manipulated against them primarily, and how it's not working for them. And then they realize, yeah, you're right. Inflation isn't normal. I don't know why I always thought it was. And you have to walk them through it. You've been taught all your life that 2% inflation is normal because you can stomach it. But the reality is it's not normal. And when you get people around to that understanding, that thinking, they start critically thinking for themselves, and they think, yeah, is there another way? Is there another way?
You probably know more about this than I do. My recollection is that 2% number just came from like a paper that somebody put out in New Zealand in the 80s or something like that. Is that all it is?
That's correct. That's correct. And I can't remember, and I apologize, I cannot remember if it was in New Zealand or Australia, but it was in that kind of time zone.
Yeah.
But that's right. And it came out from a paper, and they figured out pretty quickly, central banks adopted it, widespread adoption on it, and figured out pretty quickly that, hey, this is what we can get away with, and people won't complain about it, and they'll just accept it, and they'll think, oh yeah, well, 2%, that's economic growth. No, that has nothing to do with economic growth. If you listen to Jeff Booth, you'll realize that the natural state of the advancement of technology is for deflation, that everything gets cheaper, and it's almost impossible to wrap your brain around first hear that. But once you think it through and just sit down and think it through and think about that, you realize, yeah, we should be getting a whole lot more for our work and our money and our developments and our advancements. Like, why are we not? And so I remember I had this argument with my brother once about how, and he's into technology, he's a computer science engineer. He was in college, not anymore, but and we would have this argument about, well, now that we have a BlackBerry, you can do your work anywhere. It's so much more productive. You're doing, like you basically, you can spread your work out, and you won't have to work as much because it's not as consolidated in that 8-hour period, and you can just get it done as you're going along. And I argued with him because I had been using a BlackBerry for almost 2 years at that point. I was like, it's just making me work longer hours, harder. Now I'm able to trade New Zealand and then Australia, and then just a few hours later I'm trading in Europe, and I don't get an hour off. Basically I get like 2 hours off, and that was it. And so but in reality we should be getting more for it, but it's not giving us more. And that example was an inflation of working hours, but the inflation that we're experiencing, as we all know, it's not natural. It's forced by central banks printing more money and expanding that supply to battle that deflation, and those forces they're fighting against each other, and that's what people are feeling. They're like, why is this not working? Why am I having to pay $9 for a dozen eggs all of a sudden? Like, what is going on here? And maybe it's back down to 5, but yeah.
James, I gotta tell you my first BlackBerry story. So my first investment banking job was when the BlackBerry was getting adopted, and there was a group. I was in the M&A group, and there was another group, which is the restructuring group, and the restructuring group adopted it for all their analysts first, and so they got the first exposure. They used to call it the leash, i.e., the leash that you're stuck on like an animal, because your superiors can contact you at any time for any reason to get you to do work like you just described, right? 24/7. And fortunately for me, the M&A group waited a year. I can't remember, waited a year or two. And so I didn't get put on the leash until a year or two later. Thank God. Made a real big difference in my quality of life.
Yeah, and then they just became crackberries, right? So that was it. Yeah. But
that's it. Well, let's talk about 2%, because some people say inflation in your average country around the world is not uncommon, right? Like, how many countries in the world are there where 5 to 10% annual inflation is totally normal and common? So I guess my question for you is, with the backdrop of where debt is, take this any way you want to, is higher than 2% inflation to be expected? What are your thoughts?
Well, The answer is it has been higher than 2%. And if you listen to people like Lynn Alden, who is extremely intelligent, then you realize, yeah, the inflation has been closer to the expansion of the money supply, which is over 7% since the 1970s. Once we got off the gold standard, we let the central bank off the leash. And so they were no longer leashed to gold, and they could just do whatever they wanted. And now, so you're seeing the money supply expand, and changes in the definition of inflation continuously, like constantly changing the definition of inflation, whether it's a basket of goods and it's tied to standard of living. That it's insane the way that they change the definitions along the way. And so, but because we are now, Andy, we're running $2 trillion plus deficits at a time that we're not even in recession, and we're running these deficits that are just ungodly. And so, what is happening? Well, our debt is expanding at a rapid rate. So we're adding $1 trillion of debt every 100 days at this right now. On this pace that we're on right now. That's just insanity. And so what do they need to do? Well, talking about that's literally the debt spiral, because you're operating in a deficit, and then you have to issue debt to pay off old debt and to pay the interest on that old debt, because you're not making enough tax revenue to cover that cost, which is your mandatory expenses, which is your entitlements, which are Social Security, Medicare, Medicaid. Those are not going away. Those are signed into legislation. You're stuck on those, right? And then your other expense is military. That's not going away. We're spending somewhere between $800 and $900 billion a year on that. So between those two, you're already approaching $5 trillion right there. Mm-hmm. You're getting $4.4 trillion of taxes. Okay, so now you only have $600 billion left over, but your interest expense is $1.1 trillion. So there's $500 billion of debt that you have to pile on just to pay the interest on your old debt. And this is called the debt spiral. There's no way out of it. It's like running up credit cards, and you take out more credit cards to pay off the old credit cards, and eventually you get to the point where you just spiral into such a debt hole that you can't get out of, and you go bankrupt. Well, because we're a fiat-based debt economy, we can print money, and so we'll never just flat out default, right? So we won't go bankrupt. But if you talk through your options there, what are your options to pay down that debt or to right that ship on the deficit? Well, you can cut expenses, but like we just talked about, your entitlement, your mandatory expenses, including military, including your interest on your debt. Now, military is it's not mandatory, but it is important to a point. We won't debate whether sending tens of billions of dollars overseas every few days is responsible or not, but they're long-term contracts that they're not going to walk away from. So those are all they're paying for those. So what are you going to do? You're going to cut entitlements? I mean, that's political suicide. Mm-hmm. So you start cutting Social Security, Medicare, Medicaid, unemployment benefits. That's no politician's going to do that. You'll never get reelected. So the system is not set up with the incentives to do that. The incentive is to get reelected, not to do right by the public. So that's not going to happen. The second thing you could do is you could raise taxes. If we raise taxes, you wind up, what happens when you raise taxes in history is that you wind up disincentivizing productivity. You disincentivize and you make it difficult for profitable companies to expand on profitable lines, to invest in research and development, to become more profitable. So they wind up tightening their belt because they have higher taxes. It's just like we saw out in California. You raise the minimum wage, and what happens? Well, fast food companies who now have a $20 minimum wage requirement, they have to cut workers because the demand is not there. It's just now the cost is higher, so they have to cut workers. It's the same sort of idea. But the problem is, and you get to the same spot. So you have higher taxes on lower GDP, on lower productivity. And so you wind up getting to the same spot, except it's even worse because now your productivity is declining, right? So in the long run, it doesn't work. And raising taxes is not the answer. So what's the other thing you can do? Well, you can just issue more debt, which is what we're doing. But how do you handle that? How do you deal with that debt that you're just piling and piling and piling on? Well, you allow for high perpetual structural inflation. And that's what you have to do in order to allow this and to keep this charade going. And so the answer to your question, Andy, is we're at the spot where I expect inflation to keep going up. I don't expect us to, unless we some sort of economic catastrophe or a real sharp downturn where we have a contraction and an economic contraction here that really is steep and sharp. I expect us to continue to have high inflation and for that inflation to keep going up, because not just because it's necessary to pay down the debt, but because we are using expansionary and fiscally expansionary policies, which are inflationary, and that is going to continue to feed into our prices, and that's just reality. That's a long answer to your question, but
that's everything right there. I mean, you nailed how. Well, first of all, I want to highlight what you said earlier about the expansion of the money supply. To me, I haven't dug into this as much as you, but when I tried to figure out like what is the real inflation metric and gauge, you can't really trust CPI. You can't trust any of the other alternative metrics out there, but M2 and the rate of expansion of M2 seems to line up pretty cleanly. Yeah, you have to zoom out a few years to see that show up, but that's the rate of inflationary expansion, which just goes right back to the core idea from Austrian economics of when you print money, that causes inflation. And anybody who says otherwise is trying to deny reality. And, it's a shame that we live in that world, but
yeah, totally agree. And when you ask, people are asked this all the time. Politicians are asked it. Our leaders are asked it. Powell was asked it on 60 Minutes just 6 or 8 weeks ago. Why 2%? Where's that number come from? And his answer was a 90-second word salad answer, made absolutely no sense, and it basically boils down to what we said before. It's what we can get away with, and we're going to get. That's what we're going to tell the people it is. We're going to do what we can to get it down. The optics of it. They're not getting inflation down to 2%. We may have a moment here where we have some sort of contraction and we have deflation for a moment, but they can't have that. So we know long term that the optics may look like it gets down to 2%. Reality is the money supply expands. Eventually, the inflation picks back up, and it does catch up. Why? Because when you have debt to GDP, it's running over 120%, 126, 127% now. You have no choice as an operating sovereign that based on fiat dollars than to expand the money supply and allow for high structural inflation in order to expand the GDP nominally, which means without inflation. Because if you expand GDP nominally, which is fake productivity, then there's more dollars to pay down that past debt in the future when you go to tax those. So put it this way. If you're buying long-term U.S. debt at 5%, my belief is you're going to lose on that trade because you're not going to have the same purchasing power with that money when you get paid back in 30 years or 10 years. When you get paid back, it's not going to be worth that principal you paid plus the interest that you were paid along the way. It's just not going to be worth.
That's a perfect example of real wealth destruction or confiscation that is being sort of implemented through policy. And now we're starting to see increasing talk about unrealized gain taxes or, what are your thoughts on things?
I think it's ridiculous.
The capital gains tax proposal going from 20% to 44%. Will we see more and more aggressive actions like that implemented as actual policy?
I think they'll hide it, and they'll raise capital gains taxes through different demographics or financial demographics, not social demographics. But I think they'll different levels. They'll have different measures and hurdles for you, and kind of hide it. Say, well, no, we didn't raise taxes. Yeah, well, you kind of did, and they will do that to some extent. I believe at least this administration, I believe, will. I don't know what Trump will do. My guess would he would lower taxes for capital gains because he doesn't want them. And his friends don't want them. That's my guess. But can an unrealized capital gains tax go through? Absolutely not. That's a non-starter. We would lose hundreds of billions of dollars of GDP and productivity in a nanosecond. They would leave the country. And if you're a hedge fund manager, if you're a VC capitalist, and you are going to be hit suddenly with this crazy unrealized gain tax, what are you going to do? Are you going to sit there in Palo Alto? Are you going to move your entity from a Delaware corp to
Hello, Cayman Islands,
Grand Cayman's corp, and just you're out? Peace. I'm going to continue being a billionaire. I don't need this. Here's my passport. I mean, like they would just be. It's nonsensical. I can't see that happening. However, it's political. It's all gamesmanship. Is what we continue to see from election to election. It's all gamesmanship. Because if you ask somebody, Jesse, in 2 years, if you ask somebody, can you believe that capital gains tax? I mean, that was pretty ballsy what Biden put through. They would say, yeah, it's great because the rich should be paying more. They wouldn't even know it never went through. All they did is they heard it, mainstream media repeated it ad nauseum, and they think, oh, yeah, they took care of me. That's all they want to do is send that message, we're taking care of you.
Well, they got one thing working for them automatically, which is bracket creep, right? Which is if we have ongoing high inflation and therefore the nominal price of everything goes up, well, then you're making more money, at least in terms of income tax. And so you're creeping up in the brackets over time. So there's unfortunately, though, I don't think that gets very far in terms of the holes in the budget that you just described. It's sort of a rounding error. I wonder what you think, James, of the geopolitics and ongoing conflict and risk of conflict. You pointed out rightly that the entitlements are very hard to change, but the military budget might have a significant upside, I guess. Who knows? What do you have any thoughts in that regard? Have you modeled it, or is it really more you're thinking more directionally?
No, I'm just thinking more directionally. I think everything goes up. I mean, I'm thinking more along the lines of if we have a recession, Andy, typically in a typical recession, your entitlements, those expenses rise by 8 to 12%. And at the same time that your revenues drop by 8 to 12%. So just think about that, 20% jump in your current deficit. So if your deficit's run at $2.2 trillion, or even $2.5 trillion, now you have a 20% jump on that. Now you're at $3 trillion. What are they going to do? They're going to print money. They have to print money. They cannot have this continue like this. So that's my thesis, is that we will see continued expansion of the money supply. There's no way around it. And, it's just reality. It's a mathematical reality. So I'm not really worried about the expansion of budgets like military. I don't think that they're going to be able to cut entitlements because it's political suicide. My bigger worry is that they just won't be able to pay for it. And so what they'll do is they'll say, well, we can't pay for Social Security. So by my age, I'm Gen X. So I'm in the crosshairs. I've paid into this thing for 30 years now. And in 15 years or so, they're going to say, yeah, sorry, we don't have it for you. And I'm still paying in. And so what are people my age going to do? They're going to vote for some sort of expansion on it. They're going to vote for the money supply to be expanded to take care of us. Well, you took care of the boomers. Why don't you take care of us? And
Vicious
good luck,
cycle.
millennials. You're up
Yep.
next. And so that's just the reality of where we are. It's mathematical, and I think the system not only allows for it but incentivizes people for it.
Yeah, the political will. It does feel like we're sort of sleepwalking towards the event horizon, and people think like, it's far away, and we have plenty of time to turn this ship around, and we have a lot of ability, and if we just pull ourselves together, we'll be able to get out of this gravitational pull, no problem. But as you pointed out, like there's no political will to cut entitlements. There's no political will to drastically cut back the military budget, and so therefore there's no ability for austerity, and any levers that you have to turn the ship around are suddenly gone. So we're just letting interest expense and deficit expansion pull us deeper towards the gravity well, and in many ways we've already passed the effective event horizon of the event horizon adjusted for our ability or political will to get out of it. We're already done.
Not to get into the minds of politicians, because God knows that there's a lot of space up in those minds, but but they're looking at it and they're saying all they know is, because they don't even read these budgets, they just hear it from their aides, but all they see is, well, we can't even make budget on just our mandatory stuff, so it doesn't even matter if we spend more. We have to print anyways. We're already taking out that credit card and another credit. We might as well. Who cares? There is no debt limit right now. There's no ceiling. We just pause.
Yeah.
So there's just like this kind of like there's a cloud up there that we just keep marching up higher on, and so
until after the elections, quite conveniently.
And so we're just going to continue to march forward like this because there's really no incentive otherwise. So yeah.
So one of the surprises to some maybe has been the strength of the dollar, notwithstanding the fact that its deficits and money printing as far as the eye could see. We had a question actually from a friend, Eddie. He's thinking about the Plaza Accord and actions that the government could take to weaken the dollar if necessary. Is that something you've thought about, or is the problem solved just by virtue of the fact they're going to print more money?
No, I think that it's different than when we had the last Plaza Accord. I think now it's quite different, and a few things there. First of all, the reason that the dollar is so strong is because our interest rate. Look at our 10-year, which is the bellwether of the world. That is the benchmark Treasury government bond of the world, the U.S. 10-year Treasury. Well, that's up, at over 4.5%. If you look across the world, even Italy is down at 3.7 or 3.8, right? It's way below, right? And I haven't looked at it in a few days, so I'm quoting off the cuff. But that, if you think about it, that's just a pure, that's called the carry trade, and it's interest rate parity. And so what it means is if our interest rate here in the U.S. is a lot higher than interest rate out in Italy, then what we'll do is you'll short the Italian bond, right? And it's 3.76 right now, the Italian 10-year. You'll short the Italian bond, you'll receive euros, you'll buy the US dollar with that, and then you will buy US treasuries, right? So that function right there is what's pushing up the US dollar. And you're seeing it happen across the world. And especially, we've seen it recently quite a bit in Japan, where the yen, because the Japanese 10-year treasury is manipulated so low that the interest rate on that is manipulated so low, meaning the Bank of Japan is buying a ton of their own 10-year treasury bonds because they want to keep stimulating the economy. They want some inflation. They're buying that, but it's unnatural. And so what winds up happening is the yen becomes the escape valve. And because it becomes the escape valve, you see the yen rise, which is actually a drop. So the number of yen per dollar is rising. That's what you're watching. So when you see the yen go up to 150, 160, that's not a good thing for Japan. That means the yen is getting weaker. It's a number of yen per dollar. So what's happening? Well, the investors in Japan they're selling the Japanese 10-year treasury, right? The JGBs. They're shorting them. They're receiving yen. They're selling the yen and buying dollars, and they're buying U.S. treasuries because they're getting a better return here. That's interest rate parity, and that's what's happening. So that creates strength in the dollar.
Whether you're a seasoned Bitcoiner or brand new to the asset class, Onramp provides a best-in-class private client experience to ensure that your Bitcoin remains accessible, secure, and in your control. You'll have a dedicated advisor to guide you every step of the way. If you want to meet in person, we now have Onramp Branches in New York, New Jersey, Philadelphia, Nashville, Dallas, Austin, Houston, Los Angeles, and Denver, with more on the way. Check out onrampbitcoin.com/branches to learn more and get connected with our team.
Yeah, I love that clear explanation, as always. So appreciate that, James. Let's talk a little bit about Bitcoin now. Pivot. It's 15 years old. Where do you think Bitcoin is along its path to monetization in the context of the world you've described?
It's just a baby. I mean, if you look at the world and you pull out all, and you put together all of the investable assets in the world, that real estate, I have seen from Statista and different metrics, is up around. It is quoted in a lot of different metrics, but if you just assume that total investable assets between real estate, stocks, bonds, the collectibles, rare collectibles, gold, it's about somewhere around $900 trillion, and gold is about 15 trillion of that, and Bitcoin is about a tenth the size of gold. I mean, it's just a tiny fraction of this investable universe. I mean, just a tiny fraction. So the reality is, Andy, it is just now beginning to come into its own as its separate asset, and that is the most significant development of the ETFs. That is why the ETF approval is so significant. It has not had a significant impact on price yet, in my opinion. That's just now beginning, but Bitcoin needs to get around this, up around somewhere around the size of gold before it does become an asset that is a completely separate asset class that will start drawing investments and allocations from things like stocks and bonds. So right now, it's still seen as a risk-on asset, just like a tech stock. Eventually, as more and more of these managers, especially in the institutions that are now buying the ETFs and are going to have that on-ramp to buy them, the RIAs, the endowments, and pension funds, once they are looking at this and understand it and start legging into it, because they can with the ETFs, and we can talk about why that's such a significant shift here in a second. But once they can do that, and once they do leg in and get a little bit and start doing the work, they're going to realize that, wow, this really is a different asset class. And because there's so much liquidity now, but once it gets there and the volatility dampens, it will dampen down as the larger it gets. And so there's a few functions for that. One of the functions is they get a percentage in their portfolio. Bitcoin rises in price. They wind up selling a little bit because they're just rebalancing. If it falls in price, they wind up buying a little bit because they're rebalancing. They want to keep it at that 1, 2, 3% level, whatever it is in that portfolio. And so they'll just keep rebalancing. You'll see this, and that's a lot of money that's rebalancing. And so that will dampen volatility in the future. And that, when the volatility is dampened, when it is somewhere closer to the market cap of gold, that's when we will see it really mature and come into its own as a separate asset class, in my opinion.
Yeah, that sounds right. Jesse probably won't mention it himself, but I will. In terms of sizing asset class and the opportunity, he has a classic slide on that. Michael Saylor just put it on screen, I think, for the recent MicroStrategy event. And yeah, agree with you completely. We are so early. Bitcoin is so small. One of my favorite things about Bitcoin adoption is I see these waves of different sources of capital. And with every new group that adopts over time, there's still another bigger group that can't even touch it until it's even bigger, right? Mm-hmm. And so I wonder if you'll comment maybe on how you think about these different sources of capital. You know, maybe it's now with the ETF has opened up either private wealth or other channels to a greater degree. But how are you thinking about these, whether it's governments, you know, or pensions, institutional money, individuals? How are you thinking about these waves of adoption where we sit today?
Yeah, I mean that's an important piece because if you're a pension fund and you're something like CalPERS, California Pension Retirement, you know, like, or you're Texas teachers, you have massive amounts of capital you have to deploy in, and it's not just one portfolio, there are hundreds of them, right? So you've got all these portfolios, but they will have, if Bitcoin's going to be separate asset allocation across a number of those portfolios, they've got to be able to invest not just tens of millions of dollars, but possibly hundreds of millions of dollars in this thing. And, you know, and so, or billions of dollars, you know, they've got a ton of capital they've got to move. Look at Fidelity, look at State Street, UBS, BlackRock. These are entities that have somewhere between $5 and $12 trillion each that they're overseeing, and if they're allocating to portfolios, I mean, we're talking about massive amounts of capital. The ETFs are important because they take away an operational and structural issue, right? Because if you're an institution, if you're a portfolio manager, you really didn't have access to this as an asset class until now. You didn't have the capability to buy it. People don't. I hear this all the time. Well, why wouldn't, you know, if they're so big and they're so smart, you know, why wouldn't a pension fund just go ahead and buy some? Well, okay, that portfolio manager you're talking about them buying something that they consider crypto. Number one, they don't understand it yet. Even if they do understand it, then they've got to educate people inside that operation to understand it well enough. And they've got to get buy-in from a number of people. They've got to get buy-in from their chief investment officer. They've got to get buy-in from their compliance officer, their general counsel. They've got to come up with some sort of operational plan around it. Why? Well, who's going to hold the keys? Who's going to oversee that? Are they going to have multi-sig? What's the hierarchy of that multi-sig? Who's going to be on that hierarchy? And how does it work? You know, are they going to be kept on some sort of hard? Are they going to be kept in cold storage, a hard wallet, on exchange with a custodian? Like, who's going to custody that for them? And then once they figure all that out, you haven't even gotten to the point, well, let's start trading it. Well, who's going to trade it? Is it an approved exchange? Is it someone that's regulated with the SEC? Can we trust that? What about settlement? Who's going to settle it? Are we going to hold it? Is our prime broker going to settle it? Or do we have to have a different prime broker? Or can we margin it? And where do we mark it? Do we mark it at midnight? Do we mark it at midnight in London? Do we mark it at the New York Stock Exchange close? Like, who marks it? Like, these are all things that they had to, but in one fell swoop, and, you know, second week of January, boom, it's all solved. Because now you have an ETF that's a spot ETF that has the underlying asset in the ETF, and they know that they can buy it, trade it, settle it, custody it. margin it. There's not getting any margin in it now, but eventually, I believe in the future they will. But it's all the same as a regular stock, as a regular tech stock. Boom, done. They can do it. It's not a problem. So that's where, it is just a baby, but I think it is maturing. And we're just at the beginning of that maturity cycle. And this influx of institutional capital is very important for the maturity of Bitcoin becoming the ultimate store of value, because it will dampen that volatility eventually when enough capital comes into it. That's my opinion on it anyways.
I love the connecting the dots that are out there for anybody to connect. Of like, I've recently been thinking a lot about a report that Two Ocean Trust put out that analyzed the data to show that a portfolio with 1% to 2% Bitcoin not only performs better, but has overall lower volatility as a portfolio.
Because it's uncorrelated. It's an uncorrelated asset class. Now, let's be real, okay? And I'm not delusional. If we have a downturn in the market, Bitcoin's going to get hit. I would be shocked if it didn't. The only reason it wouldn't is because we had an absolute collapse of fiat currencies across the world, and people are looking for something to put their money into that's not fiat. That's not likely. It's the ultimate black swan, right? And I don't hope for that. I think that would be catastrophic for the world economy. So, but otherwise, yeah, everything. It correlates to one, because if you're a portfolio manager and have lived in this spot where you're in a hedge fund and you have $5 billion that you're in charge of, and you have a black swan event over the weekend, say, well, at any moment during that weekend, first of all, the first thing you can do is take some Bitcoin off your exposure, because it trades 24/7. So you could do that. You could do it with Bitcoin futures, or if you're holding Bitcoin itself, you can sell the Bitcoin again. That's number one. The other thing is, when you walk into the market Monday morning, you're selling a certain percentage of everything. You just walk in and say, just sell 5%, 10% of everything. I can't figure out where the liquidity is. I just need liquidity, and I can't worry about the differences in what I'm exposed to. I know that I'm going to need capital, because the whole market's going down and I could get margin called, and I need some cash, and I want to get ahead of it quickly. That's what happens. So everything correlates to one. That's not atypical. However, during market fluctuations that are normal, well, Bitcoin's showing to be uncorrelated, and that's important. And that's, I think, Jesse, that is the explanation of that dampened in volatility. It helps.
Yep. And then you connect that with what you were just talking about these big capital allocators having 5 to 12 trillion each. And if you put stock in those numbers of 1% to 2% actually is good for portfolio performance and overall volatility, then what's a 1% allocation of 5 to 12 trillion per you're talking 50 to 120 billion allocated to Bitcoin. Like, of course, that would have to be proven out over time, and it'll take some time for people in those positions to get comfortable with that and for that to be incorporated. But you just mentioned like 4 or 5 large capital allocators who all could make a decision to head in that direction, because it's overall good for a portfolio to have 1% in Bitcoin, and that would move the needle massively towards Bitcoin becoming as large as gold.
Which is why I think, very good point, Jesse. I believe that I agree. And why I think that one of the next big catalysts is going to be the public announcements and the filings of these companies that say they do own the Bitcoin ETFs. And you're going to see some names on there that will surprise you, my guess. And that in and of itself is exciting and all, but that's not the point. The point is that if I'm an investment manager at Invesco and I see that Texas Teachers is in Bitcoin, I'm thinking, well, suddenly this has all changed, because 2 years ago, if I was in Bitcoin and somebody found out about it, it's a reputational risk. It becomes my fiduciary duty is maybe I'm pushing the envelope, but now it's flipped. So the risk of not owning it becomes the that becomes a question of fiduciary duty. How did you Bitcoin? If Bitcoin does go from a $1 trillion asset to a $10 trillion asset over the next 5 to 10 years, and you don't own it, then you're going to have to answer to that. Why didn't you own any? How did you not see that? It's because people are going to look back and say it was obvious. We all look back and say, well, it was obvious that Amazon was going to rule the world. But I can tell you guys, I'm a lot older than you. I can tell you back in 1999, when this thing was trading, at ridiculous multiples, we were all looking at each other, and I had a portfolio manager who shorted it, got his face ripped off. But, because they didn't believe that anybody was going to put money, like they weren't going to put a credit card on the internet to buy things. Are you crazy? They'll never happen. And they're not going to sell more than books. This electronics thing is just nuts. They're not going to sell it more than, now they are the largest marketplace in the world. Right. So, but you look back and say, well, it's obvious Amazon was going to be, it was obvious that Apple was going to be the leader. It's obvious that Microsoft, no, it wasn't. No, it wasn't. But it becomes a reputational risk at some point. And I think that's where the narrative is going to begin to, that's where it starts to change, is when you see large, important, influential, very successful, and very smart managers who start owning this thing. And then you have to answer to, why didn't you own it? Well, it doesn't, if I own 0.5%, 1%, it's not going to kill me, but at least I can say I was in it. It becomes it becomes a defensive thing. Then it becomes cover your own ass the other way.
That's it. The benchmarking. What is the benchmark? What is the index? One of the things, James, that I've struggled with in my financial advisory practice, wealth management practice over the years is, what do we benchmark ourselves against? And there are some global asset benchmarks, like Morningstar has one. And I think that gold, I want to say that gold is included in the Morningstar benchmark, although I'm not 100% sure. Bloomberg has benchmarks. There's other index providers, and I have to wonder out loud. When does Bitcoin get included in that benchmark? How much further do we have to go? Are we one cycle away? Is it a certain scale? Dollar level? Is it when it hits parity with gold? We know it's coming at some point. It's just a question of when.
Yeah. And I think it's going to have to be a lot closer to the market value of gold for that to happen. But there's going to be plenty of alpha to be created in between here and there. And the managers who are out ahead of it are going to benefit from that alpha that they create. It doesn't matter that it's volatile, because it's an asset that's volatile to the upside, which just gives you opportunity to trade around and add to.
That's it. There certainly are opportunities for alpha when the target and the current price are a difference of 1,000%, right? You're talking about $15 trillion for gold, and at Bitcoin today, current prices, I think we're under $1.5 trillion.
Yeah, and think about that. So if you're a money manager, like I said before, if you're a money manager, I have a 3% position I want to maintain in this asset. Bitcoin doubles from here, goes to 120. Now your position's just gone to a 6% position. Well, you peel back. Bitcoin comes all the way back to 90,000. Now you add to it. Bitcoin goes back. So you're just because of your rebalancing, this thing is so volatile. Your rebalancing is going to generate alpha for you, likely.
Yeah. You're making hay just by riding the volatility and adhering to a rebalancing standard.
Exactly.
That's awesome.
Well, I want to return to the question of credit, because one of the things you pointed out earlier was in the weekend event, sell anything scenario. Of course, Bitcoin gets caught because that's leverage at the fund level for some of these crossover investors who are normal traditional finance funds who now maybe have 1 foot in Bitcoin or a few percentage allocation to Bitcoin. I'm curious if this is something you've looked at with the Bitcoin Opportunity Fund, but one of the things we've all been waiting for is reasonable leverage facilities, ways to borrow against Bitcoin. In my humble opinion, they don't exist yet, but I would like them to. And I'm wondering if you have any thoughts on how that market could develop, whether you're playing any role in that at all.
All I can say is we're looking for companies, and we're looking at some companies that are looking to do that. We have not levered our Bitcoin. Would we in the future? It really depends on the structure of the facility that's offered. But we are looking at some companies that are doing that or looking to do it and are growing that. So will we invest in those companies? Maybe. It depends on, again, the structure of it. But I can tell you, I think it's coming. I think it's going to be a very big market and an important market, especially if you don't want to outright sell and realize taxable gains on an asset that's super volatile, but do want to have the access to the liquidity. I think it's going to be important. Yeah.
Yep, makes sense. This market will continue to develop as Bitcoin eats more and more, or higher percentage of those major asset classes in the world. It's going to be an interesting area and path to watch for sure. Well, we're getting up toward the end of time here. I want to give you a chance to talk about anything we haven't covered just yet, whether it's about the Informationist or the fund or anything else. Anything else you want to leave people with, James?
I got cut off there.
Yeah, I can hear you. Your audio is back, so you're frozen video, but I think we can hear you.
All right.
Sorry. So we're.
You want to repeat that? Sorry.
Yeah, sorry. Just to close here, we're running up on time. I encourage people to check out your newsletter, The Informationist. Is there anywhere else that you want to point people toward with respect to your work or what you've got going on, or anything else you want to close with?
No, I think this has been great. I'm active on Twitter. At James Lavish is my Twitter handle. The Informationist is free. It comes out every week, and you can find that at jameslavish.com or go to my Twitter handle, my bio, and you can find information there. If anybody wants information about the Bitcoin Opportunity Fund, you can just go to www.bitcoinopportunity.fund and just attest that you're an accredited investor. We can give you more information on that. We are closed for our first fund, but I do expect that Bitcoin will do very well. There will be an expansion in the space, and there will be demand for more investments there in the future, and we'll have future funds. That's my guess. So we're happy to send people some information around it so they can be prepared for that.
Excellent. Well, thank you very much, James. Really appreciate it. It's been a great conversation. Thank you so much for coming on Scarce Assets.
Well, thank you for having me. I appreciate being here with you both. I look forward to the next time.
Yes. And for everyone out there, really subscribe to the Informationist. He's putting out unbelievable value for free. So I don't know what you guys are doing if you haven't. I sure look forward to reading them.
Thank you, guys.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.